Hello everyone, my name's James Hall and I'm an investment specialist at Cazenove Capital. And now Neil, Andy, Brian and Darren have asked me just to spend 10 minutes or so explaining to you what's happened in markets so far this year. Many of you may have seen that it has been a very, very tough period, so to that end I'm just going to explain what's happened, why it's happened, and indeed, most importantly, what do we think's happening going forward. So if we start by looking back at equity markets, you can see here the various different regions and what's happened, and the purple or pink bar shows you the performance over the half year of the various markets. The one on the far left represents all world, and you can see that's down over 10% over the year so far, which is a very difficult start to the year. The brunt of the losses though have come in the US, where it has endured its worst start to a year since 1970. So what's happened? Why has the market sold off so sharply? Well, really, it's all about inflation. Coming into the year, there was lots of hope around spending and inflation staying in a very modest zone, but that was quickly stifled by the entry into war of Russia and Ukraine, which saw energy prices, oil and gas, spiral out of control and therefore inflation pushing very, very high. High inflation is difficult because it means that central banks have to put interest rates up in response to cool the economy. What that means is that companies face higher borrowing costs, and indeed individuals face higher repayments on their mortgages and also their loans, which means their ability to spend money in the economy is lower. So often it can lead to periods of recession, which is what the market's very worried about. So it's been a very difficult start to the year for equity markets, but you might note there that the one market that's done well is the UK. You might be thinking, why is that? Does that mean the UK is in for a good period? Well, sadly, it's not about that. It's unfortunately the fact that the UK has lots of oil stocks and mining stocks, and these companies have done very well over the first half of the year because the product they're selling has gone up significantly, as I've just mentioned. So typically when we see a sell-off in the equity market, the fixed income or bond world tends to go up in value and hold portfolios up, because when markets go down, that goes up. It's typically how the relationship works. But that has not happened this year. In fact, it has been the worst start to a bond market since 1788, which is a very, very long time ago. And you can see here that every sector that you can invest in the bond market has pretty much gone down. Why is this? Well, it's all about inflation again. If inflation's high, interest rates are going up. At the start of the year, if you'd given your money to the US government for 10 years, they would have repaid you with 1.5% per annum. Well, at the moment, this time next year, the US interest rate is expected to be 3.5%. So locking into 1.5% at the start of the year now looks particularly unattractive, and therefore the price of these bonds has fallen sharply to reflect the fact that things have changed. Actually, at this point in the year, you could do the same trade and get 3% per annum from the US government. And actually, I think that's not a bad trade. So there could be a point that we're looking at these and thinking, actually, there's some better value to be had from them for the first time in a long while. So equities and bonds have been very, very poor. Let's have a look at the other asset classes. And you can see here, probably no surprise to any of you, that oil has gone up significantly. Anyone that's put petrol in their car in the last 12 months will really be feeling that. And that's good if you hold oil companies, but it's not very good in terms of inflation. High oil prices effectively a tax on the economy, we say. Away from oil, gold has actually been poor this year. When you expect it to be positive, it's been negative. In sterling terms, it has actually been virtually flat. And that's because, and you can see from the next bar chart, sterling has actually been 10% weaker or so against the dollar over the year so far. Not so good news if you want to go away to America on holiday, but actually it's good news if you're an investor and you held US equities, because whilst US equities were down 23% or so in the first half year, you only lost 13% because sterling has been so weak. So that's about what's happened. Very difficult period for markets. What's the outlook? What are we thinking from here? So firstly, we're going to look at global growth. So this chart just shows growth going back over the last 22 years or so. And you can see we've had two periods when growth has actually been negative for the year, one being the great financial crisis and the other being COVID. So looking forward from here, we're seeing growth that's a below trend of 2.7% per annum. Now that's not too bad, you might be thinking, and it isn't that bad. It's just that at the start of the year, growth was anticipated to bring around 3.5% for those 2 years, which is significantly higher than 2.7. So we are facing a period of slower or stagnant growth. And when you combine this with higher inflation, you get a term that economists call stagflation, that you might have heard a lot in the news. So we're in a stagflationary environment, which is very challenging for markets. So in terms of how do we get out of this, well, one key point is for the inflation element of that to settle down. So if you look at inflation here, you can see UK inflation. Do we think it's going to be settling down? Well, you can see we think it's nearly peaked, but actually we do see it peaking now 4 or 5 months from here. And one of the real reasons for that is that in the US and Europe, they've just passed on the oil and gas rises to the consumer. Whereas here we have these price caps, and our next price cap is set to come off in October. And when that comes off, our energy prices will go up, and that will be inflationary. It's not all doom and gloom, however. Oil prices have settled from their highs made a few months ago, and we do think they will drop below that. And this will mean, hopefully, that inflation will settle looking further out 6 months to the next year. And that's a key thing and sign that we want to see. Because if inflation settles, it means that central banks can stop rising rates as aggressively. And as I said, high interest rates, whilst it's good for savers, it is a bit of a tax in the economy because people have got to be paid more on their loans and their mortgages. So here is the market's anticipation for interest rates in a year's time. So that's the red dots. So in the US, I said earlier, it's going to be about 3.5% next June, if the market's right. And in the UK, you're looking at about 3.25%, which is higher interest rates than we've seen for a long, long time. So I mentioned the R word, recession, at the start. Are we heading for a recession? I think that's a real key point. And I think certainly the odds of a recession have gone up significantly. And if you look at this chart here, it's just showing the S&P 500, which is the US stock market, in the blue line. And every time that that's gone below the black line, it's typically followed by the red line, which is manufacturing. And negative manufacturing essentially equals recession. We do think that the red line will probably follow the S&P, and we might see a recession there. But I'd say the positive from this chart really is that we've seen such a drawdown in the value of the S&P that actually it could turn the corner soon, and we could see that rallying up back to as it has done in the past, as you can see there. So we've taken a lot of the pain, and it could be that just round the corner we might see the bottom and the markets turn. Away from that, another area which is quite interesting because values have been pulled down so much is the valuation. So how much are we paying for companies that we're buying? And if you look at this chart here, where the blue and the pink lines meet, we're looking at the long-term average. So if you look at the long-term average there, you can see that today the US market is bang on that average, whereas a year ago it was way above its average. It was very, very expensive. So right now it's reasonable. And if you look at the UK, Japan, Europe, all of these look very cheap in relation to history, or at least the last 15 years or so. Away from that, just a quick mention on earnings, because earnings is a key factor in that chart. Earnings have actually been quite good this year, and indeed we're just seeing the first companies come out in Q2 with their earnings, and most have beaten estimates, which is a good thing to see. So really, in conclusion, we've seen a huge amount of pain in that first half year. It's been, as I said, one of the worst quarters for bonds and equities that we've seen in a long, long time. And inflation's high, sentiment is low, and it actually feels a bit doom and gloom. But if you look at the companies and how much you're paying for them, they do look, almost cheap by some metrics. So it could be that we see markets turn the corner very soon. For us as investors, it's just a case of keeping it quality, so buying quality companies that are robust and can survive difficult periods. And when we see the right signs, be it lower inflation or higher growth, we will add some risk to our portfolios as we see fit to try and participate in any rally that might follow. So that's it from me. If you do have any questions, please do pass them to Neil, Brian, Darren or Andy, and they'll get back to you. Thanks for your time.